All right, guys, so you're considering buying a home and you're wondering whether buying down your interest rate is a good idea or not. Today, we're going to talk about a couple different ways that you can buy down your interest rate, and we'll go over the pros and cons to figure out whether it might make sense for you. If you don't know me, my name is George Morales. I'm a licensed lender here in the state of California. I make these videos to hopefully provide some education and show you guys that home ownership is still possible. But I think for the most part, if you're considering buying a home and you've done a little bit of research, you may or may not have heard that you can either pay points or make sure that your lender doesn't charge you points when you are buying your home purchase. Really what points means is that you can pay a fee at closing to be able to buy down your interest rate. Now there's a couple different ways of buying down your interest rate. One is called a permanent interest rate buy down and the other one is called a temporary interest rate buy down. And they each work a little bit differently. So we're going to talk about both. The first one that we'll talk about is a permanent interest rate buy down. So when you get a mortgage, you can get the standard, what's called a par interest rate, which means that that's just the market rate for the day and you don't pay a fee for it. You don't get a credit back from the lender for it. It's just what the standard rate is for the day. And you also have the option of reducing your rate via a permanent interest rate buy down. And so what that means is that you can really get any rate on the chart. It just depends on how much money you're willing to go ahead and spend for it up front in exchange for that lower rate. And so when using a permanent interest rate buy down, what that means is that you're paying a fee at closing in exchange for a lower rate for the life of the loan. So if you have a 30-year mortgage, you'd be able to pay an extra fee at closing. This is in addition to your closing costs, which is just a standard property taxes, titling, insurance, appraisal fees, things along those lines. In addition to that, you're paying an extra fee. These are known as discount points to be able to reduce your rate for the life of the loan, regardless of what term you have. So an example would be if your rate is at 6.5% today, but you feel more comfortable with a lower payment, let's say at 5.75%, you can ask your lender how much that fee would be to reduce your rate to 5.75%. And that fee gets added to your closing cost in order to reduce your rate for the life of that mortgage. So how much that fee is really going to depend on several different factors. It can vary by the day, the type of loan, the credit score, and it's also known as paying discount points like I previously mentioned. And 1 point equals 1% of the loan amount that you pay at closing. And that can often reduce your interest rate by maybe about 1/4 to 0.5%, depending on the pricing, the program that you use, your credit score, again, these several different factors. But in general, as a general rule of thumb, when you pay 1 point at closing extra to be able to reduce your rate, it'll get you a reduction of 1/4 to 0.5%, somewhere in that range. Now, is paying a fee at closing a good idea or not? Well, this is really going to depend on your specific scenario and a little bit of math. We'll take an example of a $500,000 mortgage, and let's say your interest rate is at 6.5%. This is going to put your principal and interest payment at $3,160 per month. And now let's say you want to buy down your rate to 5.75% because you're just much more comfortable with that lower payment at $2,917 per month. So you tell your lender that you want to reduce your rate to that 5.75%, and they say that you need to pay 2 discount points in order to reduce your rate by that much. And so again, 2 discount points equals 2% of the loan amount, which is $10,000 in this case if we have a $500,000 loan. So what we're trying to solve for here is how long or how many months of savings will it take for you to break even, because what's happening is you're saving $243 a month, but you just pay $10,000 to be able to reduce that rate. So the math on this is simple. You take that $10,000 that you paid at closing and divide that by $243, which is your monthly savings, and that's going to give us $4,115. And so this represents the months that it takes for you to go ahead and break even. What this means is that if you sell or refinance prior to this 41 months, you didn't allow enough time to pass and let the savings kick in, and you just wasted some or all of that money depending on when you refinance or you sell. So this permanent rate buy down option can be a good idea if you like the monthly savings and your intent is to keep this property long term, so you don't plan to sell this property before that 41 months, which is just under 4 years, and you also don't think that you're going to refinance, because again, keep in mind that rates are forecasted to drop in the next few years. So if you don't think you're going to refinance or have to refinance with a 5.75% rate, then this might be a good scenario for you. The other thing is that this $10,000 fee at closing doesn't necessarily need to be paid by you. It can be paid by the seller. So if you can negotiate for the seller to pay for this $10,000 fee, then it's their money that could go to waste if you sell or refinance prior to that, even though there's some negotiation, and that can somehow be baked into the negotiation there as well if you negotiate that. The other way to buy down your rate is to use what's called a temporary interest rate buy down. And like the name implies, we're only temporarily reducing your interest rate when we go with this option, and this one works a little differently. There are a few types of interest rate buy downs. There's a 1.0 buy down, there's a 2.1 buy down, and there's a 3.2.1 buy down. And one of the most common ones, at least in our area, is a 2.1 buy down. This means your rate's going to be 2% lower for the first year of the loan, 1% lower for year 2, and then years 3 through years 30, your rate goes back to the standard note rate. So if you buy the home and lock in a 6.5% rate with a 2.1 buy down, year one, your interest rate would be 4.5%. Year two, it goes to 5.5%. And then years 3 through 30, it goes to 6.5%, provided you don't refinance prior to that. Now, the first thing that you should know about a temporary buy down, like a 2-1 buy down that we're going to talk about here, is that your rate is never actually lower. What's happening is the seller is actually helping you make part of your mortgage payment for the first couple of years by way of a subsidy. There's a cost associated with the 2-1 buy down that has to be negotiated, and the seller is required to pay this. And how much the cost will be is dependent on how much the monthly savings will be to you. For example, if you have a $500,000 mortgage at 6.5%, your payment would be $3,160, but because of the program, your rate would actually be 4.5% for the first year, which would put your payment at $2,533 a month, and this saves you $627 per month. So the difference between those two payments at the different rates is at $627, and this $627 is a portion of the mortgage payment that the seller is making on your behalf for year one, which ends up adding up to about $7,500 per year at $7,524. Now in year two, your rate would be 5.5%, which makes your mortgage payment $2,838 per month. The difference in savings between the original $3,160 a month payment at 6.5% and the 5.5% payment at $2,838 per month is $322. So $322 times 12 months equals $3,864, and that's what the seller is paying on your behalf for year two. So in order to use a 2-1 buy down, if you have a $500,000 loan, you'll need to negotiate for the seller to give you a seller credit or contribution of $11,388. The homebuyers are using this program as a way to get in the door to homeownership now with a more comfortable payment, with the expectation that rates are going to drop in the next 1 to 2 years and they'll be able to refinance before year three even gets here. This could also be good for someone that is expecting to have a higher income here in the next couple of years because they're going to get a promotion, they're going to get some type of way better paying job, and they know that they'll be comfortable with that higher payment in year two and year three. Now, is this a good strategy for you? I think the answer is going to be different for everyone, and it comes down to your approach to personal finance. Some people are okay with a payment changing, and some are just not comfortable with their payment gradually increasing for the first few years. And if that's you, then this might not be a good option for you. The way I would think about it is look at what the payment would be for years 3 through years 30. And this is kind of the worst case scenario, right? And if you see that payment and it scares you or just makes you feel uncomfortable or anxious, then this just might not be the right strategy. Most people are going to refinance in the next couple of years as rates drop, but although that's the forecast, what if they don't? No one can predict what's going to happen with rates, as we saw last year in 2023. And also, people forget that you still have to qualify when it comes to refinance, meaning you still have to have a good enough credit and you still have to have good enough income to be able to qualify for that new mortgage. And things can change and things happen in life, right? What if your income ends up being lower? What if you lose your job? What if your credit is lower and you don't qualify to refinance at that time? So you really have to think about the worst case scenario. And if you look at that payment with the worst case scenario and you're comfortable with it and it doesn't scare you, then this might be a good option. But the point is, always look at all your options.